Have you ever wondered what alternative investments are? Well, let's dive into this fascinating world and uncover the mystery. Think of it like this. In the realm of finance, there are the usual suspects, stocks, bonds, and cash, that make up the conventional investment landscape. They're familiar, regulated, and often the first stop for many investors. But beyond this well-trodden path lies the lesser-known territory of alternative investments. Imagine an investment landscape that's as diverse as it is exciting. Here you'll find everything from private equity and hedge funds to art, commodities, and real estate. Each of these assets falls outside the conventional categories but holds a potential value that could make them a worthy addition to your investment portfolio. And the diversity doesn't stop there. In this alternative universe, even cryptocurrencies have staked their claim. Yes, digital currencies like Bitcoin and Ethereum, once the stuff of tech enthusiast dreams, have now become an investment reality for many. But what sets these assets apart? Well, it's their unique characteristics. They're often complex, lack the regulation you'd find with conventional assets, and carry a different level of risk. But it's these very attributes that can make them an intriguing proposition for the adventurous investor. So if you're tired of the conventional investment paths and looking for something different, alternative investments might just be the ticket. But remember, with great potential comes great responsibility. In the upcoming scenes, we'll delve deeper into the appeal, risks, and considerations of alternative investments. Stay tuned and let's continue this journey together. Now that we know what alternative investments are, why are they appealing? Imagine standing in front of a buffet. You have a plate in your hand. Would you load it up with just one type of food? Probably not. Variety is the spice of life, and the same principle applies to your investment portfolio. This is where the charm of alternative investments comes in: diversification. By investing in assets beyond conventional stocks, bonds, and cash, you're spreading out your risk. If one sector takes a hit, another might be thriving, buffering your losses. Now, let's talk about the potential for higher returns. Alternative investments are like the hidden gems of the financial world. They are often less explored, which means they can offer unique opportunities for significant gains. This is not a guarantee, of course, but the potential is there. Protection against inflation is another compelling reason to consider alternative investments. Some of these assets, like real estate and commodities, have intrinsic value that can hold up even when the value of money is falling. It's like having an insurance policy against the eroding power of inflation. What about specialty options? Well, alternative investments are like a treasure trove of unique niche opportunities. You could invest in a promising startup through venture capital, or buy a piece of art that could appreciate over time. The possibilities are only limited by your imagination and risk tolerance. Finally, alternative investments can offer access to unique markets. Ever thought about investing in a vineyard in France or a tech startup in Silicon Valley? With alternative investments, these exciting opportunities can become a reality. With these benefits, it's easy to see why many are drawn to the allure of alternative investments. But, as with everything in life, there's no reward without risk. So, what are the risks associated with alternative investments? Let's dive into the deep end. One of the main risks of alternative investments is their higher fees. These can come in the form of management fees, performance fees, or both. These fees are often higher than those associated with traditional investments, such as stocks and bonds. So, while you might be attracted to the potential for higher returns, it's important to factor in these costs as they can significantly eat into your profits. Next, we have the inherent higher risk. Alternative investments can be volatile and unpredictable. They can also be impacted by a wider range of factors such as economic cycles, geopolitical events, and even the weather in the case of commodities like crops. This can lead to larger swings in value both up and down compared to traditional investments. Then there's the reduced regulation. Unlike traditional investments, alternative investments are not as tightly regulated. This lack of oversight can lead to increased risk, including the potential for fraud. It's a bit like venturing into uncharted waters. You never quite know what you might encounter. On top of this, alternative investments can be complex. They often involve sophisticated strategies and instruments that can be difficult to understand. This complexity can make it harder to accurately assess the risks and potential returns. Finally, alternative investments may have low correlations to traditional investments. This means they might not move in tandem with the broader market. While this can be a good thing when it comes to diversification, it can also mean that when traditional investments are doing well, your alternative investments might not be. Also, alternative investments often have limited accessibility. They're typically reserved for accredited investors or those with a high net worth. This can make it difficult for the average investor to get in on the action. It's clear that while alternative investments can offer exciting opportunities, they also come with their fair share of risks. So, who exactly should be considering alternative investments? Well, the nature of alternative investments makes them a bit more intricate than conventional investments. This complexity, combined with a lack of regulation and increased risk, means they are often favored by certain types of investors. Primarily, institutional investors tend to gravitate towards these investments. These are organizations that invest on behalf of their members. Think pension funds, endowments, insurance companies, and even mutual funds. These entities have the resources and the risk tolerance to delve into the less charted waters of alternative investing. In addition to institutional investors, high net worth individuals often consider alternative investments. These are people who have substantial personal wealth and can afford to take on the increased risk and complexity that comes with these types of investments. They have the financial cushion to weather potential losses, and the patience to wait for potentially higher returns. But it's not just about being able to stomach risk or navigate complexity. Alternative investments often require a deep understanding of the specific market or asset. This is where financial professionals come in. Those with a solid background in finance, a keen eye for market trends, and a knack for identifying undervalued assets can often find unique opportunities in the alternative investment landscape. And then we have accredited investors. These are individuals or entities that meet certain income or net worth requirements set by financial regulators. In the United States, for instance, an individual must have a yearly income exceeding $200,000 or a net worth exceeding $1 million, excluding the value of their primary residence. These investors are considered financially sophisticated and are therefore given access to certain alternative investments that may not be available to the general public. But remember, while these groups are more likely to engage in alternative investing, it doesn't mean they're the only ones who can. With the right research, strategy, and risk management, many investors can potentially benefit from alternative investments. Alternative investments aren't for everyone, but for some, they can offer a unique and potentially rewarding investment avenue. Let's dig a little deeper and look at some examples of alternative investments. First, we have private equity. This involves investing directly into private companies or conducting buyouts of public companies, resulting in a delisting of public equity. Institutional and high net worth individuals are the most common investors in this type of investment. Next up are hedge funds. These are pooled investments that use different strategies to earn active return, or alpha, for their investors. They often employ aggressive strategies that may not be available to mutual funds, including selling short leverage, program trading, swaps, arbitrage, and derivatives. Third on the list is art. Yes, you heard that right, art. Investing in art can mean purchasing pieces from emerging or established artists, with the hope that their value will increase over time. This form of investment can often double as a passion project for art enthusiasts. Then we have commodities. These are raw materials or primary agricultural products that can be bought and sold, such as gold, oil, wheat, or sugar. Commodities are considered a good way to diversify your portfolio beyond traditional securities. Real estate is another type of alternative investment. This can range from residential and commercial real estate to real estate investment trusts, REITs. The potential for income comes from rental income or the appreciation of property value. Lastly, we have cryptocurrencies. While relatively new, cryptocurrencies like Bitcoin and Ethereum have become popular alternative investments. They offer the potential for significant returns but also come with a high level of risk due to their volatility. As you can see, the world of alternative investments is vast and diverse, offering opportunities that you may never have thought possible. So, are alternative investments the right choice for you? As we wrap up our discussion, let's take a moment to revisit the key points we've touched on about alternative investments. These are financial assets that don't fit into the conventional categories like stocks, bonds, and cash. Instead, they cover a broad spectrum of opportunities that include private equity, real estate, commodities, and even art. Cryptocurrency, venture capital, and peer-to-peer lending also fall under this umbrella. Now, the appeal of these investments is multifaceted. They offer the potential for higher returns and provide an avenue for diversification, which can be a protective measure against inflation. They can also open the door to unique markets and specialty options. However, with these rewards come risks. Alternative investments are complex and often lack the regulation seen with more traditional avenues. This can make them more susceptible to scams and fraud. They typically require higher minimum investments and fees, and they can be less liquid than conventional assets. This means they can be harder to sell off if you need to free up cash quickly. So, who should consider these investments? They are often held by institutional investors or high net worth individuals due to their complexity and the level of risk involved. But remember, just because they are a good fit for one investor doesn't mean they'll necessarily be the right choice for you. It's critical to weigh the benefits against the risks and consider your own financial situation. Are you comfortable with higher risk for the potential of higher returns? Do you have the necessary knowledge to navigate these less regulated markets? These are questions you'll need to answer before diving into the world of alternative investments. Remember, investing always involves risk, and it's important to do your own research and consider your personal circumstances before diving into the world of alternative investments.